Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today is Thursday, July 7th, 2016, so we're talking about energy, materials, and industrials. On today's show, we have our guest, Motley Fool contributor Matthew DeLallo, who is joining us via Skype. Thanks for joining us, Matt.
Hey, thanks for having me.
You bet. How's your 4th?
Yeah, it was pretty good. It's nice and warm down here in Charleston, South Carolina.
Yeah, did you get to see any fireworks? Because we kind of got rained out, and even though they shot them off in D.C., you could not see them except on TV.
Yeah, my neighbors have been shooting off a bunch of fireworks, so that's about all we got to see. But it was still a nice day otherwise.
Keeping it classy with the backyard fireworks.
Yeah.
So first up on today's show, and for our listeners that are not aware, Matt here is one of our top oily type energy investor writers. Great stuff. I pretty much read everything that you put out, Matt. If I don't edit it, I just read it just so I have a better understanding for what's going on in the energy markets these days. So we got some big news this week that I wanted to get your thoughts on. The U.S. is number one in terms of oil reserves now. When did that happen?
Yeah, whoever expected that to happen? According to this energy consultancy in I think it's Norway, Rystad Energy, they believe that the U.S. has 264 billion barrels of recoverable oil. Just to put that in perspective, last year we used 7 billion barrels, so that's like 37 years of oil right there. And from what they gather, about half of that shale. So this is that shale boom has just uncovered so much oil that we just didn't expect we would be able to recover.
Right.
And that puts us like over what Saudi Arabia has and over what Russia has. However, Saudi Arabia hasn't updated their estimates in like decades, so we're not even sure what they have.
Aren't they like notoriously coy and we don't actually know and or trust anything that they say about their reserves?
Absolutely. From the report I read, the last time they had updated their numbers was like 1989. They're either like remarkable and being able to produce like, millions of barrels a day and finding more, or they just haven't updated their numbers. However, we should know more. They're supposed to IPO part of their Saudi Aramco.
Yeah.
So once they do that, they really do need to disclose what the actual reserves are, because that's how oil companies are valued. So we should actually have a better idea of what they have or don't have within the next year or so. So that'll be interesting.
Yeah. Do you think they'll actually come out with their reserves? Because that seems like one of the cards they always like to keep close to their chests.
I doubt it. They might put some number out there, and if they do, I don't think it'll deviate too much from what is already out there. Just because it would look bad, if they're trying to do an IPO and cash in on some of the value of Saudi Aramco. So if it doesn't have anywhere near the reserves that they thought, that just wouldn't go over well with the market. So
right.
I think the number will be what we're used to, which is that 200 and something billion barrels.
So talk to me about Russia. So they supposedly have 256 billion barrels of recoverable oil. Do we trust that?
Probably more so than Saudi Arabia, just because they haven't been producing to the same rate. Their actual production's like right up there with Saudi Arabia, but there's a lot of technology that they're using, and they have a lot of oil in the Arctic and in Siberia and places like that. So I think those numbers are a little bit more realistic. They're not trying to corner the oil market like Saudi Arabia is. So I would trust that number.
Okay. So correct me if I'm wrong, but whenever I was reading analysis of, oil markets and reserves and everything over the last 2 years, really since the downturn started in November 2014, there seems to be a big dichotomy between U.S. supply numbers, let alone reserves, as opposed to the rest of the world. And the bottom line is we actually know way more about U.S. supply and demand than the world. And that's something that a lot of Wall Street analysts don't usually take into account.
Yeah, well, a lot of it has to do with we have so much data for U.S. supplies, and it's just become such a big topic of discussion with shale. If you look at a chart of U.S. production for like 25 years. It was consistently going down. And then all of a sudden, I think it was like 2008, 2009, it just shot up
Right.
because they were able to use hydraulic fracturing and horizontal drilling to just unlock all this oil. And as they've done that, they've gathered all this data that just shows how much, and they're finding so much more of it in just different layers. You hear about these different shale plays, and it's like a big, they almost like a pancake stack, they say, and in each layer is more oil, so they can kind of tackle these different layers, and it just has expanded, just the reserves and the data we have. So it's been pretty amazing to watch.
So as things stand right now, how much oil is on planet Earth?
According to Rystad, and it's anybody's guess, but they say 2.1 trillion barrels of recoverable oil. And so there's different ways of gathering it. There's proved reserves, which is what we realistically think we can economically produce today. Then there's what are called probable reserves, and that is what we think is there, and maybe with some technology changes or higher oil prices we can get that. And then there are these other um, inferences that they think is there. So that's what this number is based off of, is this is what we think we can get over time. And so just to put it in perspective again, that's 70 times the current production rate of the world. So basically 70 years worth of oil.
Then it's
We
gone.
think, yeah. And even to put that number in perspective, the Canadian oil stands, they think there's like 1.3 trillion barrels, but oil would have to go a lot higher to get
Well,
some of
right.
that.
So that was my question with, the 2.1 trillion barrels of recoverable oil, according to Rystad, all that stuff, what you were just saying. Is that at $30 oil? Is it at 50? Like, do you know anything about the economics? Because I know that a lot of companies have had to take a hit to their reserves just because oil was at $27 earlier this year. It wasn't economic to get a lot of it out of the ground, so they had to take a whack at their reserves.
Yeah, and this isn't, so what those reserves are is the proved reserves, and those, according to SEC, are what is technologically producible and economically producible. So that number is way lower. According to the U.S. Energy and Information Administration, the U.S. has 29 billion barrels, so that's about 10%. So
Yeah, that seems low.
yeah, and that number has been going higher and will go higher. But again, it's a function of the oil price and whatnot. So this Rystad number, this isn't even based on just proved reserves. This is based on discoveries they anticipate us making over the years. So it's probably more based on what they would call the marginal supply of oil number, which is about right now $65 to $70 a barrel. And what that means is that that's the price oil needs to be in order for companies to start ramping up their investments, particularly in like deep water and the Arctic and these higher cost plays. So that's pretty much what this number would infer. Oil would need to be probably about $80 a barrel.
Got it. Okay. So that actually leads us to our next topic. Over the last year, I've been reading a lot about, and you would see it in like company presentations, and oil's crashing, but all these companies like EOG Resources or somebody, they were trying to, assuage investor fears, and they're saying, oh, don't worry about it. We're making just as much money at $45 oil as we were making in 2012 at $65 oil. And the bottom line and the conclusion from all this is $80 a barrel in terms of profitability for U.S. oil companies, particularly shale producers. Is it the new $100 oil? I mean, what do you think?
Absolutely. It's been remarkable to watch just how innovative these companies have become uh, in order to drive the cost down. Now, there's basically two types of costs that they'll have. There's the service cost, which is like, hiring a Halliburton or a Schlumberger to come in and provide drilling services or whatnot. And then there's just the innovative cost deflation that they've been able to capture. And this is the multi-well pads. This is drilling longer laterals. This is using, getting more productive wells. So a lot of this is fundamental, structural, meaning it'll be there in the future. Um, so costs will come up. So, what they could earn at $30 a barrel isn't going to be, the same margin if oil were to go to 80, because companies like Schlumberger and Halliburton, they'll raise their prices for
Hmm.
some,
And they've
supply
been
and
cutting up, in the last year and a half for obvious reasons.
yeah, yeah, but there are certain efficiencies that they've gained that are permanent, and one of them is just drilling longer wells. So, back in the day, oil companies would drill straight down, it would, vertical well and try to tap a pool of oil. Today, they're doing this horizontal drilling. So they'll drill down and then they'll turn the well and go horizontally. And at the start, they were just doing a couple thousand feet. Now they're doing 2, 3, 4, 5 miles
Oh my
horizontally.
gosh.
And
So it's going down and then going
yeah,
5 miles east, west, or north or south or something.
right. So they'll go down 2 miles in a lot of cases, and then they'll go, in any direction, several miles. And along the way, they're fracking, which is the actual breaking the rocks and whatnot. And so as they've kind of figured this stuff out, they know that the longer they go, it might cost more to drill a 10,000 foot well versus a 5,000 foot well, but you're not doing the stuff at the top, so it's less per foot. So that's been a huge thing. You see a lot of companies, especially in the Permian Basin. That's why they're doing all these acreage exchanges and buying acreage, and it's so that they have a bigger surface area that they can drill down, and do these longer laterals. So that's been a huge thing. Another big one is to use more sand. And what that does is it props up the rocks underneath. So companies like Laredo Petroleum and EOG Resources and Devon, they're finding the more sand that they pump down in these wells, the better. And it's just these little tweaks that they're making that are making a big impact. So a well that might have done 1,000 barrels a day is now doing 1,500 barrels a day,
Wow.
and they're lasting longer. So the decline, it used to be 90% in one year. So a well that was doing 1,000 barrels the first year might do 100 barrels the next year, but they're able to adjust that through these little tweaks. And it's not just what I guess we wouldn't even call them technology advances, but then you have actual technology on top of it where they're using data, uh, doing 3D seismic. And so what they'll do is they'll basically have a picture of what it looks like underneath, and they'll have heat maps which will show this is where the sweet spot is. There's the most oil along this layer of rock, and what they'll do is they'll drill down, they'll turn the well to follow that accumulation of oil, and then they'll frack along there. And it doesn't cost them all that much more, but the production they get back is so much better doing this, that it has dropped the cost down to where $40 is the new break even as opposed to 80, which was a couple years ago.
Gotcha. So all of this seems to imply that the market being oversupplied with oil, but that might be here to stay. They're just able to get more oil out of the ground. They're just going to keep doing this. But you actually seem to have, and you're backed up by a bunch of analysts and oil CEOs, but kind of a bullish perspective on oil prices. What do you see happening?
Well, we have see there's the oil is there, it's just getting it out of the ground. And one of the things that I don't think a lot of people understand about oil is wells deplete. And so a well that's producing 1,000 barrels a day today will do 500 next year, 250 the next year. So that continually has to be replaced. And in addition to that, demand is growing. Low oil prices are making more people decide, oh, I'm going to go on vacation, I'm going to drive. So, you have those competing things where supplies are going down naturally and demand is going up. So, a lot of analysts and CEOs think that what's a glut today will be a shortfall by the end of this year. And it could be as much as 1 million barrels a day. And it could expand to 2 million barrels a day next year if companies don't ramp up investment. And that's kind of where I lean in the it's bad now, but it's going to get a lot better. And the profits are going to be really good because their costs are so much lower now. So they can make, upwards of like $40 a barrel. If oil goes to 80, that's a huge, huge, huge profit margin.
Got it.
So Yeah, it looks much more exciting after the past couple of years.
Yeah, they what was it, adapt or die? What was it Harold Ham was saying he thought oil would be at the end of the year? It was like $70 or something.
Yeah, and I take Harold Ham, for a grain of salt sometimes, but he does make a good case. He says 72 to thereabouts, and he points out this big shortfall that's coming. Now he's been wrong a lot, but it doesn't mean he won't be, right this time. And I think the data does back him up this time.
Gotcha. Okay, great. So who really stands to benefit if all this bears out? I mean, is there any companies that you definitely like no matter what happens, but especially in this scenario?
Yeah, so the two hot plays right now, the Permian Basin and it's called the Stack Scoop play in Oklahoma. And the reason they stand out is because they're economical to drill right now. Pioneer Natural Resources in the Permian Basin can earn a 50% rate of return at $50 oil. That's why they're growing their production like 12% this year, and they just added more money to grow their production next year. They have a fantastic balance sheet. So whether oil stays where it is or goes higher, they stand to benefit. Other big shale kings like EOG Resources and Devon Energy, they both have great positions in either the Permian with this EOG and Devon, or Devon also has the stack. So they're in those two key plays. And then as oil goes higher, it opens the door to these other plays. The Bakken becomes important again. The Eagle Ford becomes important again. There's some places out in the Rockies that these companies can tap in. So it's just a huge window of opportunity for them. And then another one I would throw out there is Halliburton. They have a huge North American, oil field service business, and as these companies ramp up, Halliburton's going to be the first call they make.
Got it. Awesome. All right, Matt. Well, thank you for your thoughts. Have a great day.
No problem. You too.
Yep. That is it for us, folks. If you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that's industryfocus@fool.com. And as always, people in this program may have interest in the stocks that they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear on this program. For Matt DeLallo, I am Sean O'Reilly. Thanks for listening, and Fool on.